Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. Late last year, a few bullish patterns started to emerge and eventually led to a move up towards a combined resistance in mid-April this year of the 2012 high at 241.05 and a November 2011 high at 243.40. On the way up, prices punched up through the November 2014 high at 201.35, the 50% Fibonacci line of February 22 to January 23 move at 201.70, the April 2023 high at 204.90, the October 22 high at 216.25 until peaking just over the November 2011 high at 243.40. The move up happened so quickly I didn't have time to set up topside targets for it before it peaked and headed back down, all the way back down to the combination of the bright red declining neckline of the April to May 2022 reverse head and shoulders pattern, currently 198.30. The 50% Fibonacci line, the big old 2011 to 2019 move at 198.30 also. And most importantly, the very slowly rising purple highlighted medium moving average, currently 194.30, where prices have seemingly stabilized. 4 weeks ago, I had a look at the longer term charts here, and this is what I saw, and I quote: "The key move there was over the 50% Fibonacci line of the 2011 to 2019 move at 198.30. This has seemingly validated the action since September 2022 to date as a possible double bottom, Adam and Eve type. Thus, potential targets for such a pattern topside would be a primary target X1 in the 235 even zone, with a secondary harder to reach target X2 up in the 251.60 area. These are early days, but that is what it's looking like right now." End of quote. Well, prices reached the primary target X1 in the 235 area, exceeded them even. However, target X2 up in the 251.60 area is still live for the moment, and also still above the market. This leads us to where we are now, and I have a conundrum. You see, to me, the action since the start of this year looks like an inverted diving board pattern, with the flat run in, the shoot up and drop, and now the climb out. But inverted, it's upside down. The only issue with this is there is no such pattern. I can't find one. You can have a diving board pattern with a V bottom or a V top, but not with a run up from a fairly flat congestion area as we have seen. This leaves me with nothing other than a V top pattern, which I feel is still only half the story. Anyway, the V top stroke inverted diving board pattern is over, and that seems that prices may resume their rise from the support of the 50% Fibonacci line of the bright red neckline, and especially the purple highlighted medium moving average below. However, how far higher? Well, on that I have my reservations, as this is quite a high hill to climb, and today we're on the verge of making possibly a daily key reversal down. And so the medium moving average may be under threat, and also everything underneath that. London coffee. During the process of the market breaking higher from back in December last year, prices started to stabilize for a while. This process of stabilization ended up with a late January 2023 to early March 24 being a bullish halfway hesitation pattern between roughly the lesser Fibonacci levels at 30.16 to 18 up to the January 2024 high at 32.61. As all this was happening 11 weeks ago, we had the short medium moving average, currently 35.68, enter the frame from below and turn prices even higher. In the process of making this halfway hesitation, the late January, early March action also became a small bear channel come declining expanding wedge pattern. 10 weeks ago, prices shot up through the upper bear channel line, stabilizing again over it this time, and then the market, taking its own sweet time, started to exploit the upside. As I said 7 weeks ago, and I quote, "It nevertheless still lays out all sorts of possibilities topside." Thus, if we look at the bear channel as a bullish halfway hesitation, then we need to look at 2 points from where to start measuring from. The first is the January low at 27.44, and the second is from the mid-December 2023 start of the rally in the 25.20 area. Thus, for the first pattern, we would have a potential target X in the 34.80 area, whilst from the second origin, you could see up as far as a potential target X1 in the 3700 area. Well up and off my daily chart. End of quote. A few days after my commentary, target X at 34.80 was reached, and soon after, the hardest to reach target X1 in the 3700 area was also achieved. All this action allowed me to draw a new pattern. At that time, a bright red late November 2023 to late February 2024 bullish Andrews pitchfork. The market seemed to fit well within this pitchfork, but 4 weeks ago, prices shot up and out away from the upper time, but only as far as a 100% projected Fibonacci line at the time at 43.09, before pulling back to sit on top of the upper time. Soon after, prices turned lower again, this time with greater force, pushing down through the bright red upper, middle and lower tines. And add to this the changeover gap in early May, and prices have dropped down as far as the combined January high at 32.62 and the slowly rising medium moving average at 33.31, where we have so far, well, sort of stabilized. I said as much 2 weeks ago when I reported, and I quote, "Something will have to give, and soon, within the next 2 weeks, as by then, rising red upper tine will reach the 100% projected Fibonacci line. It is this proximity that is sowing the first seeds of doubt about the market being bullish in the first place. I'm not as confident on the bullish incentive as I was last week, but we shall see." End of quote. Well, we did see, and we saw prices pull up. Overhead is a short medium moving average, currently 35.68, but the bright red Andrews pitchfork is no longer valid, and I will remove it after this commentary. This does still leave some light congestion in the 36.70 to 37.30 area, and then the 50% Fibonacci line at 3800. But first is the changeover gap, 34.40 to 35.34, and it'll be interesting to see how the market plans to fill this, having already done a reasonable job in a partial fill, but then today turning round back down again and possibly making a daily key reversal and looking at the medium moving average below.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.